The Relative Strength Index, or RSI, is a momentum indicator originally developed by J. Wells Wilder Jr. In this video, we'll take you through what it is, how you can use it, and the advantages and disadvantages of doing so. The RSI is used in technical analysis and measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of the asset you are trading. It is calculated using the average price gains and losses over a given period of time, and the default time is 14 periods with values between 0 and 100. It's generally interpreted that RSI values of 70 or above indicate that an asset is becoming overbought or overvalued and may be primed for a reversal or pullback in price. An RSI reading of below 30 indicates oversold or undervalued conditions. The RSI will rise as the number and size of positive price closes increases, and it will fall as the number and size of losses increases. As you can see in the chart, the RSI indicator can stay in the overbought region for extended periods of time. The indicator may also remain in oversold territory for an extended period of time when the stock is in a downtrend as well. It can be confusing for new traders, but learning to use the indicator within the context of a prevailing trend will help clear up the issues you have as you progress in your trading. As mentioned, the RSI is considered overbought when above 70 and oversold when below 30. These traditional levels can also be adjusted if necessary to better fit the asset you are trading. So I'll show you here. If I click on settings, I can adjust the periods here and where the levels are of overbought and oversold conditions. For example, if an asset in our case which is the Euro USD, is repeatedly reaching the overbought level of 70, we could simply head over to the settings and adjust that level to 80. The RSI also forms chart patterns that may not show an underlying price, such as double tops, which you can see here, resistance, which you can see here, and it can also be used for divergence. A bullish divergence occurs when the RSI creates an oversold reading followed by a higher low that matches correspondingly lower lows in the price. This indicates a rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. So as you can see here, we've got lower lows in price, higher lows on the RSI, and if we were to enter on the break above the 30 level, we would then get in right at the beginning of an uptrend. And on the flip side, a bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher highs in the price. So what are the advantages? The RSI compares bullish and bearish price momentum and displays the results in an oscillator beneath a price chart. Like most technical indicators, its signals are most reliable when they conform to the long-term trend. It can also be used to help you understand when a trend is gaining strength or strengthening, or if a trend is weakening. There are, of course, disadvantages. True reversal signals are rare and can be difficult to separate from false signals. And since the long-term indicator displays momentum, it can stay overbought or oversold for a long time. Therefore, the RSI is most useful in a market where the asset price is alternating between bullish and bearish trends. That's all from me. If you like our videos, you can hit subscribe and head over to our channel to see more. If you have any questions, simply pop them in the comment section below. I'll hopefully be back with a new video next week. Until then, have a good trading week.